The first section is probably going to take us all week. And you might say, what about 3 more sections, Mrs. Mars? They're fast, quick. I think we'll get through 3 sections in 1 day. And then we'll do problems, practice tests. Test is a week from Friday. Okay. We will be at this plant assets section most of this week. Now, I won't see you tomorrow, but I'll see you Thursday, Friday, correct? Okay. Yeah, we'll be at plant assets all week. And that's just how it is. It's just how it rolls. So what are plant assets? Well, I see the word assets. We must own them. Plant assets are oftentimes referred to on a classified balance sheet as PPE, property, plant, and equipment. Like, do you guys remember doing current assets, long-term assets, PPE, and intangible? These are basically all under the PPE category. So they're things we own that are going to be around for a while. They take up a lot of space. They are used in the operations of our business, but we're not going to sell them. Like, they're not, they help us make money, but they're not inventory. They're not stuff that we're going to sell to our customers. They help us provide service over the course of many years. So let's think about Willys, the grocery carts, the pallet jacks or pallet movers, the coolers, the cash registers, and the fancy, like the stuff, you said it, your stuff down at Willys, and the what? The conveyor stuff at the checkouts. Okay, they all have physical substance. They're used to do business. They're not selling conveyor belts and carts at Willys. They are there to allow Willys to do what they do and sell groceries. Make sense? I just saw through some online auction, you guys know that the Fergus Falls Target closed. Okay. Now they're selling all their PPE. They're selling the stuff that they use to do business. So they're selling carts, they're selling shelving, they're selling all the stuff because they're liquidating. They're trying to get as much money out of there as they can. Okay, but just know that PPE is not there to generate revenue from that. It's kind of a subsidiary. Willys needs carts. Willys needs the conveyors and stuff to do business. Okay, this sheet should be in your supplemental notes. Why does Southwest Airlines have so much wrapped up in plant assets? Airplanes. Yeah, but look at Wendy's. Wendy's the fast food chain. That one kind of surprised me. So this is a breakdown of plant assets as a relation to their total assets. So I don't know what Wendy's is doing if they're using really sophisticated fryers, and I mean, why doesn't McDonald's show up in the list is the question, but anyway. So what's the value of these plant assets is the big question, and you need to learn what is called the cost principle. And the value of it then is, what were those assets cost? The big thing though is you don't just look at the price tag, not just the cost, aka the price tag. One of my favorite shops in town is Sweet Lily's. Love that floral shop. Love it. Sweet Lily's has a van. Let's use Pizza Ranch. What's unique about their delivery vehicles? They're bright yellow and they have lots of stickers on them. Same thing with like the Willys van. Okay, so vans and delivery vehicles. They all came with a price tag, like whether they bought them at Heartland or whether they bought them at, you know, Ford here in town, or maybe they had to custom order them. They all had a price tag, But what you need to know about the cost principle is that the cost consists of more than the price tag. In other words, to get it ready to do what it's supposed to do. Do all of those vans and delivery vehicles have stickers on them? Yeah, a lot of them. Certain paint colors, you know, maybe the factory didn't have the bright red van for Willie's or the bright yellow vehicle for Pizza Ranch. The Sweet Lily's van only has kind of like a sticker in the back window, but those other two have a lot of stickers and a lot of just packs, you know, packed for the punch. The Willie's van doesn't have any seats in it other than the front, right? Why? Because they're putting food in it when they're delivering it. So you need to know that the cost principle is way more than the price tag. It's getting it ready to do what it's supposed to do. Sometimes people have to come in and train you how to use that asset. Those expenditures would also bring up the value of the cost. Sometimes it's not set up. I mean, a van would be a bad example. It doesn't come in pieces and you have to set up your own van. But maybe it's the cash registers at Willie's. Maybe they come not set up and someone has to come set them up and even train the people how to use them. That would all bring up the cost of the asset. For this chapter, we're going to look at land, land improvements, buildings, and equipment. For buildings and equipment, we are going to learn about depreciation, which is a contra asset. Does equipment last forever? Does a building last forever? And so we're going to learn that, yes, there comes a value with that, which we know there's lots of add-ons to that value, but it's also offset by how much it depreciates or loses value in a given year. Land and land improvements tend to not depreciate. So we're going to focus our depreciation on just buildings and equipment. So let's talk about each of them separately. Land, hunting land, farmland, lake land, a piece of property here in town, land. Land takes a look at all the necessary costs to getting that land ready to do what it's supposed to do. And not only the price tag on the land, but all the other add-ons is where you would, if you buy land, that's what you would debit it for. Because land is under the asset umbrella, specifically the PPE category, if we had to look at a classified balance sheet. Here are some costs that typically drive up the value of land. You got to buy the chunk of land first, so the purchase price, the price tag, if you will. A few other things. When you're buying property, there's closing costs through the realtor. There's title work, attorney work. It's not just I'll meet you in the alley and give you cash. You sit down at a table and you sign your life away, just like when we purchased our house that was on land. Okay? There's a lot of different fees and a lot of different people have their hand in that cookie jar that you have to pay. If you're working through a realtor, you're going to pay them a commission. All of that gets tacked on to the value of this land. And you're going to have to get any property taxes that haven't been paid yet up to date. So the land has a lot of add-on costs. What does a journal entry look like? Hayes Manufacturing acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is razed, or in other words, like tore down, at a net cost of $6,000. Now let's talk about why it actually costs $75,000 to get rid of the building. So you buy this land and there's this crappy old building on the property. You pay someone $7,500 to tear it down, but maybe you sell some of the stuff that goes with the building, the old barn wood, the old sheet metal, the old, you know, you actually make money from someone like Junk by Jenny. Junk by Jenny shows up and says, I'll take all the barn wood. And I gave them $1,500 for that barn wood, so that offsets their demo costs. Does that make sense? So that's why you see, and you see the word net. We learned about that last chapter, that involves some offsetting. Additional expenditures, they paid an attorney $1,000 and a realtor $8,000. What are we valuing this land at? Here's your breakdown. Is this in your notes? Was the little bio in your notes? Yes. Okay. So here's how we break the dollar amount down. The value of the land, $100,000. The net removal of the warehouse, which we saw the word raised, which is basically demoed. I thought it cost $7,500 to get rid of the warehouse. Why is it $6,000? Junk by Jenny showed up and bought the barnwood. Okay, so that's why we see $6,000 there. Remember, that was $7,500 minus the salvage stuff out of it. That happens all the time, all the time. Are we going to add the attorney fee in? Are we going to add the realtor fee in? So this land, although it had a sticker price of, or a price tag of $100,000, on the journal entry, it would look like it's $115,000. What would it look like if we bought this with cash? It would say land, $115,000. Cash would be credited $115,000. What if we said bill us? Instead of cash going down, what would be going up? What would be our credit if we said bill us? AP, what if we said, let's pay you 6% over the next year? It would be notes payable. That's what it would look like though. And don't be fooled by that $100,000 price tag, because there's a lot more things that added to the value of it. This should feel easy. Does this feel easy? Good. We'll wait for the hard stuff Thursday, Friday. Land improvements. Okay, well, how does this differ than land? It's the cost of all the expenditures necessary to make the improvements ready for their intended use. So let's get in some examples. Driveways, parking lots, fences, landscaping, and lighting. So if I go build a store out by the Grand Stay, I'm buying some land, but I can't have my customers, park in the ditch. I need to build a driveway to even get to my building. I need to build a parking lot, preferably that's paved, not gravel. I might need to put a fence up. I need to maybe do some landscaping, and I probably should have some yard lighting. Those are considered land improvements, different than land. These, how do you decide what's land versus land improvements? These have a much shorter useful life. The land is not going anywhere. Will a driveway wear out? Will a parking lot wear out? Will the fence eventually wear out? How about landscaping? Yeah, if you're not careful, it's going to die. And of course, lighting's not going to last forever. Have any of you seen the big light that fell down at the baseball fields? Whew. It's like crashed everywhere. It's not the main field, but. So that'd be an example of a land improvement that literally fell down and shattered. Now it's under snow. Okay. You expense or depreciate the cost of the land improvements over their useful life. So to figure out how they're going to devalue, you depreciate them. Buildings. So constructed buildings, unless you're constructing them themselves. So if you buy them, a purchase price, closing costs, attorney fees, title, insurance, and then the real States. So just like land, buildings have all those add-ons as well. A building, though, may need to be remodeled. You might have to replace the floor, the roof. You might have to redo the wiring. You might have to redo the plumbing. Are we doing, like, okay, so like let's say someone came and bought our school today, but we've entered into a 2-year plan to repair things like roof, wiring, plumbing. That would all get added on to the price. You go buy a fixer-upper house and you have to dump a bunch of money into it, that's going to go to the overall value of that. It's going to bring the overall value of that house up. Construction costs, so if you buy land and you're going to build a house or build a structure, that's going to be the contract plus payments for the architect, the permitting, excavating. So this is when you're purchasing a existing building, whether it's a house, a business, a shed, whatever. This is when you're actually building or constructing the building. All of it gets included in the building or the structure. A lot of this is probably in your notes already. Equipment. So stuff you're going to use in your business to drive more business. Here are some examples. Again, the purchase price. So let's say Willie's is buying a new cash register and the little, like the whole setup of a cash register. You're going to have a purchase price, pay sales tax on it. You might have to pay to get it to you. You may have to insure it while it's being delivered to you. And then any expenditures to assemble the stuff, install the stuff, test the stuff, or even be trained on how to use it. You know, Willie's puts in some fancy, sophisticated tills. Someone's going to probably have to come assemble it, install it, test it to make sure it's working, and even train someone at Willie's to how to use it. All of that gets rolled into the dollar amount of the equipment. I think of our locked door security system we have here at our school. Can you see that would be a good example of equipment? Someone had to install them. Someone had to test them to make sure they're working. Someone had to train our office folks on how to use it. So all of that gets rolled into that equipment cost. I think it gives a little example, doesn't it? Sweet. Leonard Company purchases a delivery truck, 22 grand. That's the price tag. Related expenditures are sales tax, painting and lettering. So we're going to stop there. We also have to put a motor vehicle license on it and have a 3-year insurance policy. These two, in other words, tabs. We had to put tabs on it and have license plates. A 3-year accident insurance policy, is that going to last forever? Those are what are called recurring expenses. You know, it could have said we're going to spend this much money on gas and oil in the first year as well. Those are something you have to constantly do. So those, tricky as it may sound, especially listed like this, those are recurring expenses that are actually going to look different. It's not bringing the overall value of our delivery truck up just because we put a 3-year insurance policy on it. In 3 years, we're going to have to put another one. We're going to have to put tabs and maybe buy new license plates after so many years as well. That is a tricky one because it doesn't get included. So what's the actual cost? Cash price, $22,000. Sales tax, $1,320. The stickers, painting, lettering, $500. for the total cost of $23,820. Again, why are we not seeing the license? Why are we not seeing the insurance? Because those are recurring costs. Those happen annually. We're not going to repaint the thing annually, and we're not going to have to repay sales tax every year. So do you see the difference between the initial purchase and getting it ready for its intended use versus making sure it's up to speed, up to date? So I think they break it down even further. Is there something else that goes with this? Do you see? Sweet. Okay. So we're seeing the same bio again with the 80 and the 1600 as recurring. They're asking us to do a journal entry for the acquisition of this truck. So we see equipment go up by $23,820. Well, what? I thought it was $22,000. That's what the price tag says. Why do we see it larger? Getting it ready to do business, yes. You are going to see your license expense be $80. You are going to see prepaid insurance be $1,600. This is an expense. This is another separate asset increasing. We own that insurance that's going to cover a 3-year policy. And then cash will be credited to pay those 3 things. We bought equipment, we bought a license for it, and we bought another asset of prepaid insurance. So this is another asset going up. We're paying cash to do all of it. We're going to stop here and do 3 exercises pertaining to just the categories. Because if I go way back, sorry, I know this is really... So is it a L, Li, B, or E? We're going to look at them 3 different times and just categorize. I want you to get really good at this. Then, I don't think this is going to take 25 minutes. And we're going to just keep going, but I think this is a really good stopping point to just see what you know. Right here. Right here. Let's do these quick. I don't think you have, well, I haven't given you your worksheet, your workbook stuff, but just you can write them on a blank notebook page. So we're going to do exercise 10-1. Feels good to be that far into the book. All right, so exercise 10-1, I'm on page 503. The following expenditures related to plant assets that were made by Prather Company during the first 2 months of 2014. So at 1 through 8, we paid all the way through 8. And then the instructions at the bottom. Part A, explain the application of the historical cost principle in determining the acquisition cost of plant assets. So just in your own words, what does it mean that it's more than a sticker price? And I want you to put those in your own words right now. The historical cost principle, or the cost principle. What does it mean in your own words that we're buying all of these plant assets that have a sticker price, and you're often seeing the value of the assets larger than the sticker price? So I'll put it in different words. Explain what the cost principle means, that it's more than the sticker price. So just why don't you do that really quickly, and then I'll show you the answers. So my answer key is always going to have a lot more detail than you probably do, and that's just okay. So under the historical cost principle or the cost principle, the acquisition of an asset should include all expenditures necessary to get it ready to do what it's supposed to do. That's what you need to know. It's more than the sticker price. It's getting that asset ready to do what it's supposed to do. And that oftentimes comes with a lot more little nickel and dime type things. And they did go into an example. For example, the cost of a factory machine includes buying the machine, getting it to us, insuring it during transit, and installing it. You don't have to give an example, but I bet maybe some of you did. So now part B. List the numbers of the foregoing transactions, so 1 through 8. And then opposite, indicate each account title to which each expenditure should be debited. Oh, that's very detailed. So basically put number 1 and tell me which one you're going to debit. L, LI, B, or E. So land improvement, building, or equipment. So let's look at number 1. Paid $5,000 of accrued taxes at the time a plant site was required. All of them are going to be assets because we're buying stuff. It's just the PPE stuff, the stuff that's going to be around. That's land. Now, had it said paid $5,000 of accrued taxes at the time a building was purchased, that would be building. I'm going to go through the first few with you, then you're going to do the second round on your own. Number 2, paid $200 in insurance to cover possible accident loss on new factory machinery while it was getting to us. Equipment. And you might say, hold the show. You just got done telling us we don't have to, like, insurance is different. Keep in mind, we've maybe just bought some, well, let's say we spent $30,000 on some piece of equipment, and it's being like shipped to us. If we're going to buy $200 worth of insurance just so nothing happens to it while it's being shipped, that's equipment. If we're going to have a 2-year insurance policy on that equipment once it's here, that's also different. So do you guys see the difference there? Number 3, we paid $850 sales tax on a new delivery truck. Equipment. We paid $17,500 on parking lots and driveways at our new plant site. LI, land improvement. Which one's going to last longer, our plant site or the parking lot and driveway? The plant site. That's how it differs from land to land improvement. Number 5, we paid $250 to have our company name and advertising slogan printed on our new delivery truck. A truck is E, equipment. Number 6, paid or excuse me, $8,000 for installing new factory machinery. E, equipment. 7, paid $900 for a 1-year accident insurance policy on our new truck. What are we debiting for that? And it's not the truck. Prepaid insurance. Star that one. Circle it and put recurring cost there. And again, I want to just now compare number 2 to number 7. We had insurance to cover that expensive equipment getting to us versus we have insurance on our delivery truck that we pay every year. You see the difference. 8, we paid $75 for our motor vehicle license fee on that new truck. What's going to be our debit? It has nothing to do with the truck. It's our license expense. I could see a lot of you putting miscellaneous expense or just the word expense. I'd be okay with that too. This kind of stuff is going to be on the test. So you're going to have like lists like this, and you're going to have to say L, LI, B, or E, or some of the other ones. What I want you to do now is try exercise 10-2 yourself. So it lists what we're buying and the dollar amount, and then it's just asking us what would you debit. And I'm okay with the L or the LI, the B, the E, or you might have prepaid insurance or expense in there too. So I'm going to give you just a minute to work on that, and then I'll go through the answers. I'll hit pause on the recording. Carrie, you should hit pause on your recording. Equipment. It's hard. Don't you see yourself like wanting to write machinery? Yeah, so you just got to think about what's under each camp. Number 4, the real estate broker's commission on land, not a building. The insurance premium paid for the first year of insurance on the new truck. Not PPE, rather prepaid insurance. Had they said insurance for like transit of equipment, then it would have been equipment. So if you're covering some really expensive equipment to be delivered to you, then it's not prepaid insurance. Paid $8,000, oh, I'm looking at the wrong one. 6, cost of landscaping, land improvements. Just remember that's not going to last as long as the land. 7, paving a parking lot, land improvements. Oh, that's a tricky one. Did some of you put building? Cost of paving the parking lot. That's not going to last even as long as the building. Cost of, ooh, this is a tricky one. Cost of clearing, draining, and filling the land. It's getting the land ready to do what it's supposed to do. Like if you go by a wooded area on a lake with no driveway, with no, like you're like walking into that thing, you have to get that land ready to even have construction being worked on. You're going to probably have to clear trees. You're going to have to move dirt. Okay. And then number 9, the architect fees on a self-constructed building. So you're building your own building, but someone designed it. Building. All right, last one. 10 o'clock. Exercise 10-3. On March 1st, Westmoreland Company acquired real estate on which it planned to construct a small office building. Can we assume that they bought land to build a building? They paid $75,000 in cash. There was an old warehouse on the property that was razed. What does that mean? Demoed at a cost of $8,600, but we sold $1,700 worth of stuff. Additional expenditures before they even started building was an attorney fee, a real estate broker's fee, an architect's fee, and they put in driveways in a parking lot. So part A is asking you to figure out what did the land cost. For each part not used, what would you have debited? So, and I want you to try to figure this out on your own, because I can't spoon feed so much. You've got to just buckle down and try it just on a 2-week chapter. So figure out of all of those things, what was the cost principle of using the cost principle, what was the dollar amount of the land? And then if you didn't include it in the land, which one got debited? Does that make sense, what I'm asking here? A is what's the dollar amount of the land? B is if you didn't use that dollar amount, which one does it get assigned to? L, I, B, or E, or other. So $88,000 can get assigned to the cost, more than just the $75,000 price tag. So out of that, it looks like 2 other things weren't included. The architect's fee for the building, you'd see buildings debited. And the driveway and parking lot, you'd see land improvements debited for $14,000. Is it starting to make sense? On a test, you'd for sure have to do stuff like this. Okay, I'd see some of like the multiple choice being like this part A. Like here's a bunch of stuff, now figure out which answer is really the cost of the land. I looked at the test today and I don't think there were a lot like this from a problem perspective, but more of a Q&A. Okay. It's 10:05. I want to just overall hit what depreciation means. And then it will be a good thing to review when I see you on Thursday. So I'm going to keep rolling with the lecture, but I'm only going to go so far. And I think we'll run out of time before I do that. What is depreciation? We know it's a contra asset. It offsets the value of an asset. You will learn that it's got a partner. It's called the depreciation expense. We'll get more into that Thursday, Friday. But basically, depreciation can be defined as allocating the cost of the plant asset, basically how it loses value over its useful life in a really systematic and like rational, true way. Our school district has a fleet of buses. Those are a plant asset. They certainly don't hold their value. Our school district has computers. They certainly don't hold their value. And you've probably heard those terms before. It's just that the amount lost over their useful life is called depreciation, and you expense it out over its useful life. It takes a look at what is it costing us to use it. Not the computer is losing value. It's more of like what we're using to expense out or cost out the use. So don't think of it as the computers are losing value. It's just an expense of doing business that they're going to lose value. it applies to LI, B, and E, but not land. If anything, land goes up in value over its useful life. So you need to know that we'll depreciate our land improvements. In other words, our landscaping, our driveways, our shrubs, the buildings, and the equipment. Land tends to go up in value instead of lose value. But remember, we're not going to call it losing value. We're looking at expensing out over its useful life. Oh, stay for just a minute. Depreciable because it's not going to keep making us money. Like as it starts to break and be torn and tattered, it's going to not be as revenue producing as it once was. So that's what depreciation is. We're going to get into the types of it when I see you again on Thursday and Friday. See you then. Enjoy your mentorships.